Cola? I'm going to answer all those questions for you by the end of this video. This is going to be the best investment advice I have ever given, and that is not clickbait, I can promise you. I'm going to explain this to you in 3 simple, fast steps. Step number 1, we have to understand the game we are playing. Investor Ian has some brand new glasses. He is looking sharp. He just got done reading The Intelligent Investor. He is ready to go. He finds a company, he says, I love this company. I am just like Warren Buffett. I am in it for the long term. It has great cash flow, awesome balance sheet, it's undervalued, and it has amazing management. The chart looks fantastic as well. What's not to like? The mistake that Investor Ian is making is that he's not buying a company. He's not buying a stock. He's not buying a commodity. Investor Ian is simply buying a probability. That's it. His investment will never have a 100% probability of going up. It will always be lower than that. So to make good decisions, regardless of what investment you're trying to make or what asset you're potentially buying, it has to start with answering the question, what are the probabilities? To get our mind in the right place, let's go over the game of blackjack. The dealer is showing between an ace and a king. You are holding either a 12 or a 19. Editor, go ahead and throw up the chart that shows all of the possibilities. But we're just going to stick with 12 and 19 to keep things simple. So if you have a 12 and the dealer is showing, let's say, a 7, you have a 26% chance of winning. If you have a 19, you have a 76% chance of winning. These probabilities are strictly defined. We know what they are. The next step would be to determine what the upside is and what the downside is with each hand. So that's generally just a chip. If you have a $10 chip, you're either going to lose that $10 chip or you're going to get another $10 chip most of the time. And you may be saying to yourself, yeah, George, I get it. I mean, I've been to a casino before. I've played blackjack. What's the big deal? But what you're not understanding is to play blackjack well. In other words, to invest well, there's several more variables that we need to consider. First and foremost is the Kelly criterion. To understand this better, let's go to an interview with Professor Ed Thorpe from one of the Market Wizards books. If you don't know who Ed Thorpe is, he was famous for beating the game of blackjack and roulette and baccarat. He also went on to start the very first quant hedge fund back in the 1960s. He is regarded by many as being one of the smartest Americans to ever live. The Kelly criterion is the fraction of capital to wager to maximize compounded growth of that capital, even when there is an edge, meaning you have the probabilities on your side. Beyond some threshold, larger bets will result in lower compounded returns because of the adverse effect of volatility. The Kelly criterion defines this threshold. For example, if a trader loses $1,000 on losing trades and gains $1,000 on winning trades, and 60% of all trades are winning, the Kelly criterion indicates an optimal trade size equal to 20%. As another example, if a trader wins $2,000 on winning trades and loses $1,000, and the probability of winning and losing are both equal to 50%, the Kelly criterion indicates the optimal trade size equal to 25% of the capital. All right, pretty straightforward. But here's where it gets interesting. Overbetting is more harmful than underbetting. For example, betting half the Kelly criterion will reduce compounded returns by 25%, while betting double the Kelly criterion will eliminate 100% of the gain. And even if you're a little confused right now, don't worry, I'm going to explain this. But remember this, that if you double the Kelly criterion size, it will eliminate 100% of the gain. Betting more than double the Kelly criterion will result in an expected negative compounded return, regardless of the edge on any individual bet, meaning trade or investment. Let me go ahead and explain that to you in English. If you're making an investment that has a 60% chance of going up, and the amount that it goes up is most likely going to be equal to the amount that it can go down. If your entire trading portfolio or investment portfolio is $1,000, you should be betting a maximum of $200. If you double that, then over time, it's a mathematical certainty that you will never make money. If you invest over $400, meaning over double the Kelly criterion maximum, it is a mathematical certainty that eventually you will go bust. And it works that way regardless of these numbers. So let's say there's a 50% chance that it goes up, but if it goes up twice as much as it could potentially go down. Again, if you had $1,000, the Kelly criterion would say your max should be $250. If it goes up to $500, you break even. If you go over $500, then eventually you will go bust. So it's about understanding probabilities, understanding your upside and downside, but it's also about the Kelly criterion, in other words, money management. This brings us to something even more important, which is the law of large numbers. To understand this better, let's go to a binomial calculator that I always like to use. Assuming there's a 60% chance that your investment goes up in the future, and that you have 10 of the identical investments, the chance to break even or lose money would be 36%. If your investments go from 10 up to 1,000, the probability of you breaking even or losing money goes from roughly 36% to less than 1/10,000th of a percent, basically zero. And the binomial calculator continues to open our eyes to the reality of investing. Let's say that your investment has a 40% probability of going higher, meaning over the long run, if you make that investment enough times, you will go bust. In only 10 attempts, there's still a 16.6% chance that you actually make money. If you made money, you would falsely assume that your investment strategy actually worked. But the more you employ that strategy, the better the chances are that you go broke. Let's take the number of trials or number of investments from 10 to 100 to see what I'm talking about. Now you only have a 1.6% chance of making money, and you have a 98% chance of breaking even or losing money. So if what Warren Buffett says is true, and that's the number one rule in investing, is to make sure you don't lose money, even if you have a 64% chance of your investment going up, you need to make that investment many times to make sure that actually pans out. To make matters worse, even if you do make money and don't have a large enough data set, you could be inaccurately calculating the probabilities. And as Jim Rogers said, if you do that, the more you invest, the faster you're going straight to the poorhouse. Step number 2, we apply this directly to making better investment decisions. It starts with a portfolio, and we go right back to investor Ian, who has a very diversified portfolio. Tesla and uranium. Well, investor Ian listened to everything we went over in step number 1, so he knows that investing is a game of probabilities, just like blackjack. So he thinks the probability of both Tesla and uranium going up right around 60%. And he thinks they both can go up twice as much as they can go down. To figure out if Ian is right, we've got to look at the fundamentals and the macro environment, of course. To do that, let's go right over to Yahoo Finance. Tesla has total cash about $3.6 billion. Total current assets about 8.3, total assets 29 billion. And that's against liabilities, current liabilities about 10 billion and long-term debt of 9.4 billion. And to pay off that long-term debt, in 2016 they made negative 674 million. 2017 negative 1.9 billion. 2018 negative 976 million. 2019, they made negative 862 million. So Ian thinks there's a 60% chance that the price of Tesla will increase from $980, $761. Excuse me, I hadn't checked that for about 10 or 15 minutes, so we'll cross that off. Let's call it $750 to be safe. Ian thinks that it's going up from $750. Now let's look at the macro environment. We know it's extremely important. So let's go to some headlines. We've got the entire country of China going into lockdown mode. QE4, negative interest rates. The repo market blowing up. And endless money printing. And are rates going up or down? The reason I ended with interest rates was to emphasize the point that rates are the price of money. And money is 1/2 of every transaction. Therefore, if we don't know the direction of interest rates, how much harder is it to determine the direction of the stock price in Tesla or uranium? And this takes us to the second step, which is determining our upside and our downside. Fortunately, this is much easier to define because you control over when you sell. So if the current price of Tesla is $750 a share, and keep in mind I haven't checked that in about 10 or 15 seconds, and you say, I want to define my upside by selling at $1,200. And I want to define my downside by selling at $500. Great, you've accomplished that. The problem is when it comes to volatility. And to explain that further, let's go right back to Yahoo Finance. Let's say you come in and buy right around 900. We'll call it right in this area. And you think the upside is $200, downside maybe $100, using the same percentages that we had from investor Ian. Unfortunately, the Tesla stock is very volatile, and it's gone all the way down now to $727. Well, your stop price was at $800, so you already got stopped out of this trade or out of this investment. Now, it very well could go back up to your target price of $1,100, and there still could be a 60% chance that it does go to $1,100, but you'll never know because you got stopped out of the trade. Therefore, your probability was a lot lower than that 60% you initially thought it was, because of the extreme volatility in the share price itself.
Compare that to the uranium ETF, and we'll use this just as a proxy. Let's say you buy right here, right around $10.25, and you think it's going up by $1, maybe down by 50 cents. We'll use the same numbers again for Tesla on a percentage basis that investor Ian was using. The same 5-day period, we go down a low of $10.11 and a high of $10.64. So because the volatility has been a lot lower here, we would not have been stopped out of the trade. Therefore, we have a better chance of actually realizing that 60% probability that we initially attached to the potential gain. Although both Tesla and uranium could have a 60% chance of going up, the chances that you realize that gain are far, far lower with Tesla because of the volatility.
You may be saying to yourself, yeah, George, I get it, but all that volatility stuff, that doesn't apply to me because I am a buy and hold investor. Okay, fine. Let's see how that works out for you. There's a 2-to-1 ratio, meaning that you can make twice as much as you can lose. And going back to step number 1, when we were talking about the Kelly criterion, we know that there's a maximum amount that we can allocate to any given investment. And if we allocate more than that over time, we will go broke. So in this example, we've allocated $250 to this investment based on the Kelly criterion. While you are a buy and hold investor, meaning that you're not going to sell for any reason whatsoever. So this 1 could very well move to a 2. Well, why is that a big deal? Because if the 1 turns into a 2, that means that you have now got way too much of your portfolio allocated to this investment. And we know, based on the Kelly criterion, that if you do that over and over again, sooner or later, you will go bust. Oh, but wait, there is more. If this wasn't complicated enough, keep in mind that our data set is way too small to determine if this portfolio or this type of investment strategy would work on a long-term basis. Remember the binomial calculator example we used in step number 1. So my point is to figure out the probabilities in these types of numbers is extraordinarily difficult. Step number 3, what is my final advice and how can it help you? That is what is most important. Going back to step number 1 and 2, we understand why in a perfect world we'd be able to turn investing into a game of blackjack. It would be very precise. But to figure out how this can really help you in the real world, we've got to look at pros who have done it well in the past. All names that you would recognize: Buffett, Druckenmiller, and Jim Rogers. The problem with Buffett's strategy is that it's very low volume. So it's hard to determine if what you're doing will actually work in the long run. Buffett counters this by investing in businesses almost exclusively for their cash flow. This makes his percentage or probabilities of getting a good investment extremely, extremely high, because the day he's buying it, it makes sense because he's buying that cash flow stream, not necessarily a future price. Druckenmiller is almost the opposite, where he rarely buys for cash flow. He's almost strictly buying because he thinks XYZ will go up in value. So the flaw in Druckenmiller's strategy, based on our blackjack model, is that the probability of him winning or losing a trade or investment bet, however you want to look at it, is a lot lower, a hell of a lot lower than Buffett. And the asymmetry, meaning his upside and downside, is a lot lower than Buffett as well. But Druckenmiller makes up for this by having a lot more volume. So if Buffett's only making 4 or 5 investments per year, Druckenmiller is making 100, let's say. So the chances, even if he's only got a 55% probability of winning, and even if there's only a 1-to-1 ratio on how much he can win or lose, if he executes that trade 100 or 1,000 times, he's going to have a 99.999% chance of coming out ahead in the long run. Going to Jim Rogers, the problem with his strategy, like Buffett, is it's very low volume. And his percentage is a lot lower than Buffett as well. But where Jim Rogers makes up for this is in the asymmetry of his investment strategy. He goes into markets like North Korea, Zimbabwe, Venezuela, the places that you would not touch with a 10-foot pole. And there's very little downside to that, but there's just massive, massive, massive amounts of upside. And he prefers to do that. That's the asymmetry that makes up for the fact that he doesn't have Druckenmiller's volume and he doesn't have Buffett's probabilities. And one thing I want to point out with all these guys, no matter what their strengths and weaknesses are relative to the game of blackjack, they all manage their money extremely, extremely well. And that goes back to the Kelly criterion. I promise you that Buffett, Druckenmiller, and Rogers know that Kelly criterion like the back of their hand. So understand the principles of blackjack. If you have to, go out and buy Ed Thorpe's book, Beat the Dealer. It's a classic, very first blackjack book I had. And as you can see, I can actually spell his name correctly. And always remember that investing is a game of probabilities. If you do this and apply what we went over in step number 1, step number 2, and then take that and apply it to the real world and how people have been successful in the past, this will help you form a strategy that will win over the long term, not based on a hunch, but based on mathematics. And that is the best investment advice I can possibly give you. Whoa, 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 time out, George. You almost forgot to answer the question, should I buy Tesla stock? Well, that depends. If you're buying Tesla because you like Elon Musk, you love the cars, or you think they're going to revolutionize the world, then 100% no, you should not buy Tesla. But after doing all the research on the fundamentals and the macro, you come to the conclusion that there's a 70% probability that Tesla goes up, and there's a 2-to-1 ratio on your upside and downside. You're using the Kelly criterion, and you have enough of those same types of investments to ensure that using a binomial calculator, you have a greater than 95% chance of winning with that strategy over the long term, then yes, by all means, buy Tesla. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.